Good morning and good afternoon, everyone. Welcome to the HLB International Tax webinar regarding tax incentives for intellectual property. My name is Shannon Lamont, and I'm a partner at Eide Bailey LLP in the U.S. I'm based in Boulder, Colorado, and I am joined by a distinguished panel, all of which will be able to speak with us regarding intellectual property incentives. First, I would like Anthony to just tell us a little bit about your background.
I'm Anthony Lalsing. I'm a tax director here at Menzies in the UK. I've been with the firm for 14 years with 10 years experience in tax. I head up our innovation and R&D team here in the UK and work with clients to maximise their R&D tax relief claims, patent box claims, and also advise on all tax aspects around the innovation lifecycle of a business.
Thank you, Anthony. Christian?
Hello, Shannon. My name is Christian Jahndorf. I'm partner at HLB Schumacher in Germany. I'm located in Münster. I'm also a university professor of law, especially tax law, and my practice in international taxation now is for more than 20 years.
Excellent. And Joe?
Yes, hello everybody. My name is Joe Stoddard. I'm a partner. I'm also with Eide Bailey here in the US. I head up our R&D tax incentives group for Eide Bailey. We help our clients identify and document US R&D tax credits, both at the federal level as well as the individual state credits.
Thank you. So for our agenda for today will be to provide an overview of incentives for intellectual property. We'll talk in detail about those incentives both in the UK and the US and what is required to qualify for those incentives. Also, we'll talk about how German companies are using intellectual property incentives. And finally, there's been a lot of tax law changes around the globe, and so we'll talk a little bit about how that impacts these intellectual property tax incentives. So with that, I would like to ask Christian, how do the Europeans take advantage of some of the intellectual property tax regimes?
Well, at the beginning, we could have an overlook on the different approaches European governments take in order to give incentive to certain preferential activities. And when we analyze the European countries, we see that almost all countries have some sort of beneficial regime in order to support R&D activities. And if you look at the technique, how governments are doing it, we can distinguish two methods. The first method is to give a direct subsidy as a direct payment for clearly defined activities, and the other section is tax incentives in a nearer sense. If you look at the development of an intellectual property as an asset, you will have two phases. First, the phase of development, and there we see that some or a lot of regimes give preferential treatment to the costs that occur while developing intellectual property. So we can see reduction of the tax base by give additional fictitious costs that reduce tax base. if we come from the phase of developing to the phase of harvesting, let's say licensing the intellectual property, we see benefits such as beneficial tax rates or tax credits. And a lot of countries give the whole possibilities beginning from preferential tax base to tax rate and taxpayers, so all of it. So other countries just grant preferential tax base in the phase of developing. So we can observe a lot of different approaches in Europe. Only very few countries do not have any sort of support, and Germany is one of those countries. And it's quite interesting to see that the reason for supporting R&D is to make the economy stronger and the export outcome more attractive comparing to other countries. Germany does not have any such supporting system, but is in the world quite successful with its economy. We come later to the point how German companies may profit or take benefits from tax regimes abroad. This is one point later. But another interesting thing is, just last week, there was a draft released by the government which they are inclined to introduce a beneficial regime in order to support R&D activities by direct subsidies. And the way how they intend to do it is connected to the tax base, especially the amount of wages such companies pay for their R&D activities. So we see in the phase of development, Germany will in future maybe introduce a preferential regime as well. And then Germany follows a trend which we observe in Europe and maybe all over the world. Maybe that's for the beginning.
Thank you. Did you want to just talk through this chart?
Well, I think it's this what's on the slide now. I've already explained more or less, and it's not. We do not take any benefit from going to each of the countries that are indicated on the slide, but it shows, it gives you an impression that it's quite common to have some sort of preferences. To the UK and the United States we come later, so we may just go ahead and take the next slide if you want.
And that first slide was related to the European countries, and this one is more on a global scale. So these will be available to you should you want to reference who has a tax regime that's preferential for the intellectual property. So going on to the UK, let's start with Anthony. What tax incentives are available in the UK related to intellectual property?
So I think the key message from the UK government is that the UK is very much open to business. And that's been apparent in recent periods when they've reduced the corporate tax rates for corporate entities. But also that it's a very friendly regime, and they're trying to create an environment where companies can create and exploit IP. And they're trying to do that through the tax system, and that's something that they're committed to doing moving forward. Turning to those tax reliefs around intellectual property, this is something that Christian touched on earlier. Effectively, you have two tax reliefs, one around the development of new IP, and one around established or existing IP. So in the UK, you have the UK patent box regime, and this is very much a tax relief for established IP. So what it does is allows an effective rate of corporation tax of 10% on IP profits from qualifying intellectual property, usually patent rights. So effectively, where you've got a patent, the profits from that patent could be taxed at 10% corporate tax rate, as opposed to the current prevailing rate of 19%. So as you can see, it's a huge benefit. Now, this was introduced in April 2013. It was then reformed slightly in July 2016. The reason for this was broadly that they felt that the UK system was more advantaged compared to other European states, and therefore in line with OECD rules and the Article 5 of the BEPS, they looked to bring that in line. So the new regime came in from 1st of July 2016. The way in which the regime works, essentially it's a streaming calculation which follows a number of stages. You start by calculating your income from intellectual property, i.e. patents. So that might be license income, for example, or sales of patented products. You then deduct direct qualifying costs that relate to that. What the government then says, on those costs, you would have got a routine return, and that is set at a default 10%. You deduct that from your profit. You also then look to deduct a marketing asset return, which is essentially saying, for a company which has a patent, let's take GlaxoSmithKline, for example, yes, part of the value is derived from the fact that they have a patent, but also part of the value is also derived from the fact that everyone recognizes their brand, their trademark, and they're trying to pull that out of the profits from their patented product. So you deduct that. You then deduct what's called a nexus fraction, which is essentially working out what R&D has been done in the UK and what's been done outside of the UK and adjusting the calculation. And then you end up with a final figure, which in essence is a deduction and means that that profit is taxed at 10%. So as you can see, it's an incredibly complicated regime. I think in terms of high level, broadly, if you've got a UK patent or a European patent, which I'll come on to in more detail later, you can effectively pay 10% corporation tax as opposed to 19%. The other regime you've got in the UK is UK R&D tax reliefs. So this is where you are creating IP for research and development. And there are essentially two regimes. You have an SME scheme, which is for small and medium enterprises, and a large regime. In terms of the size criteria, an SME would be someone looking at a group in terms of linked and partner enterprises that has less than 500 employees and either a turnover of less than 100 million euros or a balance sheet of less than 86 million euros. But you do need to look at the group situation for that. Anything larger than that would be into the large regime. The way in which the relief works, essentially you get an extra 130% deduction as tax relief for qualifying R&D expenditure. So breaking that down in terms of a numerical example, let's say, for example, you identified £100,000 of qualifying R&D expenditure. That broadly equates to £25,000 of tax relief. So for every £100,000 of R&D you identify, you are getting 25% tax relief. The other interesting point under the SME regime is we work with many startup companies or loss-making businesses where the first thing they say is, well, that's fantastic, but we're not paying any tax. Well, the regime does offer an opportunity where you have tax losses to surrender those losses and get a 14.5% repayable tax credit. So that's physical tax back to the business, even where they haven't paid any tax to the government. Moving to the large regime, effectively it's a 12% tax credit on qualifying expenditure, which is a taxable credit. So effectively what that means is a 10% net repayment to the business or a 10% net amount off their liability. So again, returning to my example, if you spend £100,000 on qualifying R&D, that would equate to £10,000 back to the business. Finally, very briefly to cover the qualifying expenditure under the R&D regime, Broadly, staffing costs are the main expenditure, and that would include gross salary, employers' NIC, and pension contributions. But you also get relief for subcontractor or externally provided worker costs, so where you use people outside of the business. Consumables, so if you're in the manufacturing industry, you might use materials for prototypes, and also software. So if you're doing software development or use software in your business, CAD, for example, for design, you can claim those costs as well. And that pretty much covers the two main strands of tax relief for intellectual property in the UK.
Thank you. That seems very beneficial and generous. So next, I'd like to ask Joe to talk through the U.S. tax incentives related to intellectual property.
That sounds good, and that is a hard act to follow, since the U.S. Incentives are generally not quite as generous as the UK. In the United States, there is some similarities to what Anthony described in the UK. The primary R&D incentive or IP incentive in the U.S. is the R&D tax credit. The R&D credit in the US is an incremental credit, which just means in order to compute how much credit is available for each year, you need to compute a base amount. And then the amount of credit is based at least partially on on the amount of spend in the current year over that base amount. There's a couple of different ways to compute the base amount. The most common method looks at your prior 3 years R&D spend. So if you're computing your US R&D credit for 2019, you would need to identify the qualified spend for 2018, 2017, and 2016. The nice thing is the base amount is only half of the average of that 3-year spend. So even if you're maintaining your qualified R&D spend on a relatively constant basis, you still get a nice credit, because you only have to, in reality, only have to exceed half of what you've historically spent on R&D. But the way that the system is set up is if you are increasing your R&D spend over your prior years, you get sort of a supercharged credit. The effective rate goes up as you compare to those prior years. And while the federal credit is typically, after you go through the mechanics of that calculation with the base amount compared to the current years, the federal credit's usually between 6 to 8% of your qualified spend. Now these are credits, so dollar for dollar tax offset in the US for once you compute the amount of credits. Most US states also have a credit, so, and those state credits can be very generous, and often the state credit can even exceed the federal credit. So when you combine, like in my home state of Utah, for example, some companies can achieve upwards of 12% of an effective credit. So when you add the state credit to the federal credit, you might get somewhere in the neighborhood of, for some states, 15 to 20% total tax, subsidy for R&D spend when you factor in the state credits. Like the UK, there is a way for startup companies that are not currently in a taxable situation to benefit from the R&D credit. This is a fairly new provision. It's only been around for a couple of years, but it allows new companies that have been around, that have been in existence for less than 5 years, and also have less than $5 million in gross receipts or revenue to make an election to use their R&D credits to offset payroll taxes. So any company in the US that has employees will be paying payroll taxes. So as long as you have employees, you'll have a tax to offset. So you can make an election to forego the income tax credit and instead use that credit to offset the employer portion of the payroll taxes. That credit for startup companies is capped out at $250,000 per year. So any credits earned above and beyond that threshold can be used as income tax credits carried forward to a future year when income tax is owed. So that's an overview of the regime in the U.S. for the R&D tax credits.
Thank you, Joe. I'd also like to talk through how companies qualify for these IP-related tax incentives, and why don't we start with Anthony on that one?
Thanks, Shannon. Yeah, so as Joe was just saying, the UK tax reliefs around IP are incredibly generous. So the first question I often get is, well, that's great. How do we get within the regime? How do we qualify? Now, for the UK patent box regime, it's fairly straightforward in terms of how you qualify. So the starting point is you have to have qualifying IP. Now, broadly, what that means is you have to have a UK patent or a European patent. And with the European patent, it can be issued by the European Patent Office or by an EEA state. So even if it's not the European Patent Office, as long as it's another EEA state, then that can also qualify. So the key point there is we are only looking at UK and European patents. If you've got a patent in the US, which is very common, that won't get you into the UK patent regime. It has to be a UK or European patent. The interesting point here is that where you have group structures, so for example, let's say you have a US parent company and a UK subsidiary, the US parent company may well hold a UK patent or a European patent. Now, the UK subsidiary may not hold a qualified patent. However, if you have an exclusive countrywide license, i.e. the US was to grant the UK countrywide license to exploit the patent held in the US, that can still get you within the regime. So I think what you need to look at is, have you got the underlying qualifying IP? And the next point is, okay, how is that structured? And is there an exclusive countrywide license? In terms of other qualifying criteria, these are around being a qualifying company, i.e. you are based in the UK or you have a UK status for corporation tax purposes, and the development requirement. Now, the development requirement is all around essentially the government protecting against a situation where someone just buys in a patent or establishes themselves in the UK with an established patent that they have not been involved in developing or subsequently developing. So what the government are looking to do is encourage business to either set up in the UK, develop IP and then patent it, and then they can claim the patent box regime, or essentially create IP and bring IP across to the UK, have a qualifying UK patent or European patent, but then continue to develop technology and continue to meet that development requirement. So just having a UK patent and a European patent doesn't necessarily get you into the regime. That's a starting point. Then you just need to make sure you tick the other boxes in terms of being a qualifying company and meeting that development requirement. In terms of the UK R&D tax reliefs, the starting point for this, and often the question that comes up and is very difficult to answer, is, well, what is R&D? And in terms of the definition, I've got some points on my slides there, but I would say that not to take too much notice of that. So if you look at what the government definition and what the guidelines say, it's broadly an advance in science or technology which creates a new product or process, or an improvement to an existing product or process. Now, that's not very helpful in terms of practicalities. So when people hear that definition, the first thing they think of is men in white coats and that stigma of laboratories, etc., and see that as being R&D, and then assume that they are not doing that and therefore they don't qualify. In terms of thinking about UK R&D, what we do tend to do with clients is talk more about certain questions that may indicate qualifying R&D. So that might be things like, how do you differentiate yourself from your competitors? Do you provide any bespoke products to clients? How do you gain your competitive edge? Do you develop things internally? Do you have technical staff, engineers, and technical software developers, etc.? What are those doing? So those kind of questions that might be indicative of R&D, but might not necessarily meet that stigma or that common assumption that it's only for men in white coats and laboratories. And just following that up, I thought I'd just give some very high level examples of the kind of areas where we've claimed R&D tax reliefs, where some people out there may think, oh, that's surprising, and I wouldn't have expected that to qualify. So the classic one is software development. I think most people would expect that to qualify. But interestingly, it may be external software, i.e. you're developing software to sell to the market. But we also make a lot of claims for businesses where they're developing internal software. So they've looked to the market. There's no software which they can help use to run their business, and therefore they've developed something internally, and that can be qualifying. I think a key point here is that it's important to realize that there might be other companies that you may know are doing similar R&D and have created similar products, but if it's not in the public domain how they've done that, then that can still qualify. So you may even end up with a situation where two companies have exactly the same product, process, and are both claiming R&D tax reliefs. Some other examples are architects. We've made a number of claims for architects and structural engineers where they're working with bespoke buildings and solutions to modify and recreate those buildings. Food and drink. So we've done a recent claim for a business which works with coconut as a substitute for products. We work with a lot of breweries and distilleries around ale, beer, spirits. That's qualifying. And also retail. We have a client who they design products for pets, so aquariums, etc. So all I'm trying to demonstrate there is the key thing is to get away from that assumption that it's only that men in white coats example that qualifies, and that any business can potentially qualify for R&D if they're solving problems and having to face challenges on a daily basis and invest money in creating something off the back of that.
Yeah, those are really great examples. Thank you. I'd also like to ask Joe if he could give us some background from the U.S. perspective on what qualifies for research and development credit.
Yes, so I guess one point to make before I dive into the points on the slide is that only activities and costs that are incurred for U.S.-based activities qualify for the U.S. credit. So even if you have a U.S. company that is performing part of the R&D, if part of that is outsourced to a company in, for example, India for some software development, any activities that occur outside the U.S. are not eligible for the credit. So really what the government is trying to encourage is for those activities and those jobs to be located in the U.S. In terms of the expenses that we can include for any qualifying activities, expenses around the wages or the labor costs can be captured, as well as supplies, and then any contract research. For both the wages as well as the contractor expenses, direct support of the R&D activities as well as direct supervision qualify. So it's not just the engineer or the scientists or whoever's doing the actual conduct of the R&D, but support personnel, maybe they're gathering requirements or performing testing, those sorts of things can qualify, and supervisory activities as well. Switching gears a little bit in terms of what types of activities qualify and the definition. Again, very similar to the UK examples that Anthony walked through. It is a fairly broad definition of R&D, just like the UK. It can apply to, on the product side, developing brand new products or making improvements or enhancements to existing products. The process, similar to the UK, the process development and process improvement also qualify. Typically, we find that applies most directly to manufacturing companies. And it would also incorporate things like modifying existing production equipment, developing new or improved tooling and fixturing, that sort of thing related to a manufacturing process. And then again, very similar to the UK, software development also qualifies, whether for internal or external use. In the US, we have a 4-part test to define what types of activities do qualify. I won't go into the detail of all 4 of those tests, but the first part is really, are you trying to develop something new or improved, like the examples I gave? Is there some uncertainty is the second part of the test. It's important to note that it doesn't have to be capability uncertainty. That certainly qualifies, but even if there's uncertainty around the appropriateness of design of the product or the process or the software, even that kind of lower level of uncertainty qualifies. So a pretty low hurdle we need to get over there to meet that test. The activities have to rely on experimentation. The way that the tax regulations that we have define experimentation is there a process set up to evaluate one or more alternatives? And if so, that meets the experimentation requirement. So that can be a scientific process of developing a hypothesis and going through the scientific method to test that out, or it can be a little less formal, even systematic, trial and error, an evaluation of different potential design alternatives would meet that test. And then finally, the activities have to be technological in nature, meaning they have to rely on the hard sciences. So again, fairly broad in terms of the sciences that would qualify, whether it's on the software engineering, computer science front, or more physical sciences, biological sciences, engineering. Anthony mentioned architectural firms in the UK can potentially qualify. Those same types of examples that he gave around, I guess, essentially all of the examples that Anthony gave would also be eligible for the US R&D regime, as long as those activities occurred in the US. So again, very, very parallel in terms of the types of things that we can look at for the R&D relief.
Excellent, thank you, Joe. And Anthony, what are some of the other issues that companies need to consider related to the patent box or the research and development credit?
Yeah, so what I've highlighted here on the next slide is just a number of the common issues we come up against more when we're looking at international groups. So just some things to watch out for. They're not specific to international groups, but they are more prevalent in international groups. So the first 2 points are fairly similar. So in terms of IP ownership and location, the reason I highlight this is because effectively, as I described earlier, the difference in regimes, under the SME regime, you're broadly getting 25% tax relief on your R&D spend, as opposed to the large regime where you're getting 10% relief. Now, if you're breaking the size criteria, you've got no choice. You're in the large regime or you're in the SME based on your size. However, what you sometimes get is, for example, I'm picking the US again, but say you have a US parent company and a UK subsidiary. If the US owns the IP, then broadly what you have is a situation where the US owns the IP and perhaps is subcontracting some of the R&D to the UK. Now, regardless of the size, because it's being subcontracted to the UK, that pushes the UK into the large regime and means that the R&D tax relief they can claim is less than if they were in the SME regime. So you might look at where do you house your IP, also looking at the patents, is it better to house it in the UK and get patent box relief? Is that preferential? and where's the best location. And that follows on for group structuring and service agreements. So if you are structuring the group to have the R&D all done in the US, and that makes commercial sense, fine, and also tax sense, great. But actually, if the UK is more preferential, do you look at housing the R&D in the UK? Do you look at what the service agreements say in terms of saying, well, the UK can get on with the R&D, it's not reporting into the US, or vice versa? If the service agreement says the UK takes its instructions from the US, are you again pushing yourself into the large regime unnecessarily? The next point is about the transition. So let's say, for example, you're in the SME regime, but the business is either growing, or let's say, for example, there is the opportunity for an acquisition or a merger. You just need to be wary of the fact that if suddenly you grow and cross from the SME regime to the large regime, that's going to reduce your tax relief. Is there a timing issue there in terms of, if you can wait till after the accounting period ends to get your SME relief and then do the acquisition after that? It's just one of those things worth bearing in mind. The next point is around subcontracted R&D and externally provided workers. So if you are subcontracting the R&D out to another company, that qualifies under the SME regime, but does not necessarily under the large regime. Whereas externally provided workers, and that's a situation where, let's say, for example, you're using agency workers to help with software development, that will qualify under both regimes. So do you look at service agreements with third parties to say, actually, we want to borrow your workers because we'll get enhanced R&D tax relief on that, as opposed to saying we are subcontracting the R&D to you? Another consideration there. The next one's an important one, and it's very relevant to businesses in the UK. So any business that's going to qualify for R&D will invariably be the type of business that may qualify for a grant from the UK government. Now, the key point here is if it's notified state aid, which a lot of the Innovate UK grants in the UK are, then that can potentially be very harmful to your R&D tax relief. So I'll give you an example. Let's say, for example, you have a project which you are going to spend £100,000 on. If you receive a grant for £5,000 on that project, you think, well, great, the government have given me £5,000, that's fantastic. But what that will do is, because it's notified state aid, the whole of that £100,000 of spend will now get pushed into the large regime as opposed to the SME regime. So the important thing there is, before you take any grants, do the calculations. Are you better off actually getting R&D tax relief in the SME regime, or are you better off taking the grant and getting large regime? And that's a discussion and a consideration to have before you take the grant. Because interestingly, even if you realise afterwards and hand the grant back, it's too late. And finally, this one links into Joe, and it's something we always discuss when we're dealing with group situations. What you'll sometimes get is, well, this is great. In the UK, we've saved you a huge amount of your tax liability through these R&D tax reliefs. Isn't this fantastic? And then what we find is, and I won't go into the US tax rules because I don't necessarily know them, and Joe can correct me if I'm wrong, but if they've checked the box, potentially in the US, those profits are going to get subsumed up into the parent company, and actually they're just reducing their double tax relief. So instead of getting double tax relief for the UK tax they would have suffered with no R&D, they're getting R&D tax relief. And what I'm saying is, actually doing the R&D tax relief, when you look at the overall group tax profile, hasn't helped them at all. So the key point there is to look at R&D not just in isolation in the UK, but within the overall group tax profile.
Yeah, that's a very good point. Thank you, Anthony. So now we've talked about the UK and the US, and as Christian mentioned earlier, the German tax authorities do not currently have an intellectual property tax incentive. So we'd like to have Christian talk about what is it that German companies are doing related to intellectual property.
Well, talking about IP boxes from a German perspective, we are talking about tax structuring. And this is a topic which is very much under discussion because there are groups of people that think this is aggressive, and there are measures or counteracting measures that try to avoid or make it more difficult to use such foreign IP box regimes. And in order to describe the current situation, maybe it is good to make the distinction between the pre-BEPS and the post-BEPS world. And in order to make it clearer, maybe we can go to one of the latest slides where there is a sketch of a simplified structure, how German companies think, yes, this is one, how they think to make use of foreign preferential tax regimes. And we have in the situation that let's say we have German companies that combines all functions of the value chain in one company, also the R&D activities. And the outcome from the R&D activities have the potential to be qualified as an asset, as an IP asset. And so this is where tax structuring thinking starts. We are looking for an IP box regime abroad, which is preferentially situated in the European Union, and which is, of course, a low tax or lower tax than in Germany, and a regime that allows preferences to acquired intellectual property, or that allows to create intellectual property by contracting out. And if these conditions are met, you can start to structure. And the usual way is to establish a company, limited liable company in that preferential tax regime, let's say Malta or Cyprus. And then one may ask, how is it possible that a newly created corporation that has, in terms of people functions, only little or low substance, how is this such a company able to acquire valuable IP and with the idea to earn license fee from their associated operative corporation in Germany? And the way how it was done in the past was to just contribute equity to the IP box, let's say the money that enables the IP box or the IP box company to acquire assets, valuable assets from the German operative company. And then the next step would be to charge license fees. This idea is very simple, but it has become more and more difficult in the times because the German legislator puts more and more burden in order to take benefits from such a structuring. And if the basic idea is clear, one could now go to to each step what tax structure I have to think about when trying to implement such a construction. So if we go back to some slides before, maybe the next one. Yeah, this is let's say it's more or less very simple. If you establish a company abroad, this company has to be recognized as a legal entity in the location where it is registered, of course, but it has also to be recognized from a German perspective as a taxable entity in another country. And the key criteria here is the place of effective management. So if you establish a company abroad, you need directors that are located in that country and that have the intellectual capability to run the business by themselves, because management contribution activities from a German associated company would do harm to any tax structuring ideas. So this is more or less the first point one have to take into account. Another point is that one can describe the term of substance if you just set up a company which characterize more or less as a letterbox company. This is not recognized for tax purposes. This is transparent. So, but if you can prove that there is an effective place of management with smart people that are able to run business, you will not run the danger of being qualified as a letterbox company, and therefore these substance criteria have to be taken into account, but then it's easily, if you see that, it's easily to deal with it. The next issue is, if you go to the next slide, please, that Germany has implemented, as I think most countries in the world, so-called controlled foreign company rules, and the German system is very close to the US CFC legislation. The initial idea was adopted by the German legislators lots of years ago, and if you have a German located company that has a subsidiary in a low tax country and that subsidiary derives passive income such as license income, then the profit of such a low taxed company is considered to be a deemed dividend, and it's added to the tax base of the German parent company. And the question if license income is really active or passive, one have to differentiate if it's if the IP, the asset that is licensed, has been created by contribution of the shareholder, let's say by intellectual contribution or any thoughts of support, then this would be a harmful activity in tax terms, which would make your activity to a passive activity, and this would be a trigger then the CFC rules, with the consequence that the German parent would have to tax a deemed dividend. Well, if it, maybe the next point one has to take into account, especially if we talk that low function, if a foreign IP box company, which is in terms of people's function more or less a low substance company, if that company acquires IP, then you have to take into account the transfer price rules. We have legislation that taxes the transfer of functions, not only the transfer of assets. So if you buy assets, then you have, of course, find out the correct transfer price. Otherwise, you have an adjustment in the tax base of the selling or buying company. It depends who takes advantage from the price. And the other point is, maybe this is not so clear in all the cases, that if you shift a function that was formerly performed in your local company, and then you shift it to a company abroad, this could be considered as a transfer of function, and function is all item in a company which potentially carries a profit. And this makes clear that if you take out a team of researchers and put them in a foreign corporation, for example, then this could trigger the tax, because you have transferred a function from one entity to the other. So and another aspect has to be taken into account, which is post-BEPS aspect, that license fees paid by the operative corporation in Germany to the IP box company abroad are just only fully conductible if the average tax burden in that country is more than 25%. This shows that BEPS or anti-BEPS brought new legislative ideas, and they have already been established in the German tax law, so that it becomes more and more difficult to take advantage from foreign IP boxes. But if we change the case a little bit and we say, okay, the IP box does not earn license fees from the operative company, but it earns license fees from third parties all over the world, then the system still works. Especially if you have it located in the European Union. So in the end, you see that unfortunately, German companies up until now cannot take advantages from an own local tax regime for R&D activities. So they have to look for advantages by using foreign tax systems. But as I've already pointed out at the beginning, we are just now on the way to establish a law which is not applicable yet. It must go through the parliamentary way, but maybe within this year or beginning from next year, we have an own tax regime which gives certain benefits which are connected to the expenses for wages, and those wages that actually are paid in order to create intellectual property, never mind which kind of intellectual property. So
thank you, Christian. So Christian has mentioned BEPS, and that refers to the base erosion and profit shifting project, which had a number of initiatives. So pressure from the OECD countries to change tax rules on a global basis. Obviously, each country has to change its own rules, and that has really, well, in addition to BEPS, there's also been tax reform in other countries as well, such as the United States. And so I'd like to take the last few minutes that we have to talk just about how these changes in tax tax laws might be impacting these incentives. And finally, I just wanted to let you know that at the end we will have probably a couple of minutes to answer questions, so you could post them in the chat box if you would like to address anything further. So first, let's start with Joe. Joe, what types of impacts are you seeing that U.S. tax reform has had on the research and development credit?
I'll just touch on this briefly, Shannon. I guess the big news from tax reform in the U.S., there was talk about, eliminating some of the special credits and deductions, and that certainly happened, but the R&D tax credit was retained. The corporate rate that was reduced from 35% to 21% does impact the R&D credit, because it is like Anthony mentioned, for the large companies in the UK, it's similar in the US where it's a taxable credit. So when the tax rate goes down, your net benefit goes up. So that's been a benefit for companies taking the R&D credit. And then sort of a sister credit to the R&D credit in the US is known as the orphan drug credit. And that's been historically a 50% credit. These are primarily for pharmaceutical companies developing drugs for rare diseases or conditions. So not broadly applicable, but when you benefit, it's a great credit. That's been reduced as part of tax reform to 25%. On the horizon, the one way that U.S. Congress helped pay for tax reform was to implement a provision that no longer allowed companies to currently expense their R&D costs, instead requiring them to be capitalized and amortized starting in 2022. I don't know if many of us believe this provision will ever take effect. I think the idea would be that they would change the law again before that date, but if that comes into play, that would be a major impact on companies with R&D in the US. I should also mention just very briefly that tax reform overall had many other international provisions that were designed to incentivize, partially at least designed to incentivize companies to keep their IP in the US instead of shipping it over, abroad. Most notably, probably the FDII, the Foreign Derived Intangible Income, has a preferential rate for IP located in the US. So that's another webcast, but certainly some provisions outside of just the R&D credit that impacted IP provisions in the US.
Thank you, Joe. And Anthony, could you also address the potential for tax reform to impact the UK incentives?
Yeah, I guess where do I start? I mean, the UK we're pretty much in turmoil here at the moment. So we don't know what our government's going to look like moving forward. We've got Brexit or no Brexit on the horizon, and that's all anyone's really talking about. So I guess it's a very uncertain time in the UK at the moment. And the main concern I get from clients and potential clients is, well, the UK tax reliefs around IP sound fantastic, but with all this uncertainty, how do we know that they're going to continue in their current form? And I think it's worth remembering that the R&D tax reliefs in the UK were introduced back in 2000 by a Labour government, so not the government we've got in place at the moment. So not only have they gone through various changes in government, changes to the tax regime, budgets, etc., they've gone through those changes and have been increased every step of the way. So when they were initially introduced, it was a 50% additional deduction, and we're now up to 130% additional deduction under the SME regime. And in that time, they've also introduced the R&D expenditure credit under the large regime and the patent box regime. So I think whatever government we have moving forward and whatever happens with Brexit, the UK government remain committed to incentivising R&D and innovation through the tax system. And that's going to remain the same, I think, even with whatever happens with Brexit. Now, what might change is the rates, the corporate tax rates, as Joe touched on. At the moment, we've got a very low corporate tax rate in the UK. That could go up. It's certainly higher under the Labour government. But I do think that the R&D regime will continue, broadly because there's a lot of empirical evidence out there which show that economic growth is a lot stronger with R&D and innovation. And as I say, the government are committed to that. So yeah, I think that bodes well for the future. The interesting point is as well, depending on our future relationship with the EU, at the moment, the UK R&D tax reliefs are governed by European state aid rules, which potentially limit the amount of relief you can claim and the way in which the reliefs work. Post-Brexit, depending on what happens, and if we have Brexit, that could change, which might give us the opportunity in the UK to further enhance the reliefs. I'm not just necessarily saying that will happen, but there is that opinion around that that might be the case. And the other thing I wanted to briefly cover was consultations. So the government are constantly consulting on the R&D regime. And at the moment, as you'll imagine, and I imagine it's the same in the US, as awareness grows and people become more enlightened about what is R&D and how fantastic the reliefs are, the claims are going up. And the government are concerned in the UK about fraudulent claims in particular. So recently they have been consulting on a cap on the SME regime based on your PAYE and national insurance, so your staff taxes effectively in the UK. The reason being there's a number of fraudulent claims they've identified where clients and businesses and companies have effectively routed costs through the UK, but haven't actually got any staff or employment in the UK, which is what innovation is designed to encourage. So they are consulting on that. They definitely want the regime to continue, but they don't want it to be abused equally. So yeah, there's a constant consultation around those, how they maximise the relief for those genuine companies, but avoid the fraudulent claims.
Excellent, thank you, Anthony. Well, that brings us to the end of our presentation. On behalf of the International Tax Committee, I would like to thank Anthony, Christian, and Joe for providing these insights into intellectual property tax incentives. If you have any questions and want to follow up, you could email us at tax@hlb.global. Thank you for attending, and we look forward to seeing you on our next webinar. Have a great day.